I am Carlo Bustos, Educational Programs Leader at Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to today's webinar, Bring Home the Money, the Profit Repatriation 101. An increasing number of companies with profit-generating trading entities overseas are finding it difficult to repatriate their accumulated reserves back home. The costs and penalties of mishandling cash repatriation are significant and can severely impact your corporate tax liabilities. In this interactive webinar, find out what's the do's and don'ts of profit repatriation and how to best leverage your company structure to avoid common pitfalls. I would like to take this time to thank Nair & Co. for helping us make this event possible and their generous support, for which helps us deliver this webinar at no cost, just like everything at Proformative. And now a few housekeeping items before we get started. If this is your first time to Proformative, welcome. Just a brief overview on Proformative for those of you who may be new. We are the largest growing online community of finance, treasury, accounting, and related professionals. We are an ad-free, noise-free community where we encourage and expect peer-to-peer collaboration. Check it out at proformative.com. And now some event notes before we do kick off. The link to today's presentation and the recording of this webinar will be sent out to all attendees within 24 hours of the event, and the presentation is currently already posted at proformative.com/resources for you to download and follow along. For those of you who like CPE credits, you will need to answer all 3 polling questions during the event today and should have pre-registered for it. For any questions around your CPE credits, please contact Chris Brower at proformative.com. We encourage questions throughout the webinar. This is going to be a very interactive, very great content session. We have 3 speakers with some very interesting insights and subject matter experts. So we really encourage everyone to ask questions, and by doing so, utilizing your questions box in your GoToWebinar control panel, and then we will try to get to all questions during the Q&A session as well as throughout the webinar. For whatever questions we do not get to, we will make sure that the questions get answered post the event directly with the speaker. And lastly, we will ask for you to take a quick survey regarding today's webinar at the end of this event. We greatly appreciate your feedback regarding it, and we always strive to continue to improve our content for the event. And so we really value your time in answering these questions. And now a few learning objectives we'll go and try to learn during today's webinar is understanding what transfer pricing issues you need to be aware about when repatriating profits, learn why your tax structures matter, discover what role international holding companies play in profit repatriation, and learn what best practices in creating a profit repatriation strategy. So now let's get started. I'd like to introduce our first speaker of 3 speakers today, Dr. Shan Nair. He's the co-founder and CEO of Nair & Co. Dr. Shan is an expert in international expansion, a highly sought-after speaker on globalization, and a contributing author for various publications. Since co-founding Nair & Co. in 1994, he has helped grow the company from a small UK-based professional services firm to a global enterprise with offices in the UK, India, China, US, Japan, and Singapore. Nair & Co. currently acts for 740-plus client operations in over 50 countries, each client operation being an average in 4 countries. Under his leadership, Nair & Co. has exponentially scaled its global footprints and broadened its service portfolio while maintaining a strong culture of innovation, ethical conduct, and dedication to unrivaled client service. Take it away, Shan.
Ladies and gentlemen, a very good day to you, and thank you very much, Carlo. In this presentation, I'm going to take you on a whistle-stop tour of 3 regions, Europe, Asia Pacific, and Latin America, focusing on a few key countries. But before I do that, I want to just preface the presentation by flagging up pitfalls to avoid. The first and most common pitfall, which is particularly an exposure in the current much more stringent regulatory climate, is that any tax plan that you come up with should have a business case underlying it. So a tax plan that's produced solely for the purpose of reducing taxes overall is much less likely to fly in the harsher regulatory climate of today than it would have been, say, 10 years ago. In addition, in some cases, particularly where intellectual property is involved, it's very important that your plan shows what we call substance. In other words, that you are able to show, if you have an international subsidiary that, say, owns IP, that it is genuinely owned and operated and managed by a team to its own business requirements and needs that may not always be coincidental with its parent company's requirements. So I just want to preface that. That is one common pitfall. It's very, very important that you should have an underlying business case for any tax plan that you produce, which is independent of taxation. Having said that, let's now look at the various destinations and review these by region. So I'm going to look first at Europe, and in looking at Europe, I'm going to pick 3 countries: Netherlands, Ireland, and UK. In the case of Netherlands, there is no withholding tax on interest or royalties. There is a relatively low corporation tax rate of 25%, with a special regime for income from innovative assets, reducing that effective tax rate to 5%. Netherlands has got an outstanding tax treaty network with a lot of countries around the world. It doesn't have any controlled foreign corporation legislation, but it does, of course, have general anti-avoidance rules. And depending on the type of entity in Netherlands, whether it's a BV or a corporatie that's set up, it may or may not have withholding taxes on dividends, even when these are non-resident companies. In other words, a Dutch co-op paying up a dividend to a U.S. parent may not incur any withholding tax at all. So Netherlands is very useful from this point of view. It's also useful in terms of the business case, because a lot of companies, particularly shipping goods into Europe, choose to do so through Netherlands to take advantage of the favorable VAT rules, where you can have contra-entry of VAT and effectively not be out of pocket for the VAT. And so you have an automatic business case if you're shipping goods into Europe to have some kind of a hub in Netherlands. And if you convert that hub into a holding company, that you're really not very exposed. Whereas if you set up a holding company there, which is just a plate with nobody in the room, that type of arrangement is a bit risky and increasingly riskier in the current economic environment. Moving on to Ireland, Ireland has exempt small and medium-sized enterprises from transfer pricing legislation. Generally, by an SME, I mean a company with less than 250 employees, less than 50 million euros of turnover, and less than 43 million euros globally of assets. Ireland doesn't have a specific code covering thin capitalization. It's got low corporate taxes. It's got no withholding taxes on interest or dividend payments to EU or treaty countries in certain cases. And it generally has no withholding taxes on royalty payments. It has an extensive and expanding double tax treaty network, and it has a pretty comprehensive unilateral foreign tax credit system. So in that respect, Ireland is again a very favorable location to put a foreign profit center into play. People don't always think of UK as a tax haven, but actually it's a pretty attractive place as an alternative to Netherlands and Ireland. It's got the same exemption from transfer pricing regulations as the Irish have, the same trigger points. It's got no withholding taxes on dividends. It does have a 20% withholding tax rate on interest and royalties paid up to non-EU parents, but not to EU parents. It's got a very low rate of corporation tax. In fact, the rate is going to be 21% next year. It has a very good tax treaty network, including with Far Eastern countries like China. But it does have controlled foreign corporation rules, and there can be restrictions on interest deductions. So if you look at these countries together, generally speaking, and of course this is very general, the outcome depends on the specific circumstances of a company, but very generally, Netherlands probably has a slight edge over Ireland and the UK because of its favorable VAT rules, which mean that you can probably kill two birds with one stone by setting up a subsidiary in Netherlands. As we will see in a few minutes, Netherlands is also a good place from where to hang your other foreign operations. So let's look at the next slide, which is Asia, and I'm going to consider here Singapore, Hong Kong, India, China, and Japan. Now, Singapore is, in our experience, an increasingly favored destination for companies setting up regional profit centers that cover the Asia-Pacific region. It has always been popular, but it is increasingly getting more popular, and part of the reason is I suspect that the government agencies in Singapore are extremely focused, very commercial, and very effective in supporting and helping foreign companies inward invest into Singapore compared to many other countries where the governmental efforts tend to become more diffuse. Singapore has no withholding tax on dividends, a 15% withholding tax on interest, and a 10% withholding tax on royalties. It's got a very low corporate tax rate of 17%, and it also has favorable double tax treaties with both India and China. So Singapore is a good jumping off point into both of these countries. The one drawback of Singapore is that it's got no double tax treaty with the US, and in fact only has double tax treaties with 65 countries. There is an agreement with the US, but it's a very limited one. But one way of getting around this is to actually have your international holding company in Netherlands and then hang Singapore under Netherlands, because Singapore and Netherlands have a good double tax treaty, and Netherlands and the US do. So having that Netherlands intermediary company backed up by a good business case for being in Netherlands in the first place could help enable you to get more of your cash back home, to quote the topic of this webinar. In the case of Hong Kong, there is no withholding taxes on dividend or interest payments, and there is just under 5% withholding tax on royalties. The corporate tax rate is a whisker below Singapore at 16.5%. It's an attractive alternative entry point into China, but not an attractive one to enter India, whereas Singapore does both. The main advantage, however, of Hong Kong is that it does not have any indirect taxes. It's got no VAT, GST, consumption tax, and therefore indirect taxation considerations are not there to cause complications to the wording of transfer pricing agreements, which is one kind of relief for tax practitioners and actually also for the client. Moving on quickly to India, India does not have a withholding tax on dividends, but effective from 1st April of this year, when an Indian company pays a dividend up to its foreign parent, there is a dividend distribution tax on the Indian company of just under 17%. That's a bit of a sting in the tail, which is important to realize before you pay up a dividend from India, say, to a US parent. India also has a up to 20% withholding tax on interest and a 10% withholding tax on royalties. Of course, India has the concept of a branch, and if you have a branch instead of a subsidiary, you can repatriate the profits after all the branch taxes are paid. But beware that the branch of a foreign trading entity, a profitable entity as opposed to a shell company, could create a significant permanent establishment of that shell company in India. In other words, that foreign company, if it's not a shell, could end up being taxed in India through dint of its having a branch in India. India is very hot on local taxation stroke permanent establishment issues. In the case of China, it's more complicated. China has a 10% withholding tax on dividends, interest, and royalties paid up to UK, France, Denmark, US, and Italy. But it goes up to 15% for Canada, New Zealand, and Brazil. For Hong Kong and Singapore, there are special rules, and the rate is effectively around 5%. And oddly enough, it is 0% with the Republic of Georgia, which is probably not a very common country to which a lot of the outward investment goes. These rules apply only so long as the foreign company receiving the dividend, say, is at least a 25% shareholder. China has significant thin capitalization rules. And in addition to transfer pricing type considerations, when dividends are paid, there are numerous government notifications that have to be actioned relating to passive income and active income. And there is a requirement to comply with numerous requirements of the Chinese foreign exchange controls. It's very important that if you're setting up a profit center in China, therefore, that you plan this right at the start properly, that the articles of your subsidiary are appropriately prepared, so that later on, when you start making profits, you can repatriate them effectively. There are many cases where people go into China in a hurry without thinking through the long-term plan, and then find they're making money in China that they have difficulty getting out. In the case of Japan, there is a 20% withholding tax on dividends, interest, and royalties. Japan has got controlled foreign corporation legislation in place, and it's got a reasonable tax treaty network with 63 countries, but it's got a very high rate of corporate tax, 39%, and it's got significant thin capitalization rules. So that covers Asia, key countries. Now just moving quickly to Latin America to complete the picture, I picked Mexico, Argentina, Chile, and Brazil as examples. In the case of Mexico, there is generally no withholding tax on dividends, but there is up to a 40% withholding tax on interest and up to 30% withholding tax on royalties. However, Mexico has got some very favorable tax treaties with both Netherlands and Switzerland that could be availed of if you're setting up a profit center operation in Mexico. We have all heard a lot of news about Argentina. Argentina requires careful planning. For example, if you are envisaging payments for transfer of technology, these can only be made if the technology transfer agreements are registered with the Argentinian regulator. There are timing limits on when distributions can be made, and there is a 35%, an up to 35% withholding tax on dividends, interest, and royalties. A similar regime on withholding taxes applies in Chile on dividends. But in the case of Chile, your 17% corporate tax rate is creditable against the 35% withholding tax. There are also numerous reporting requirements relating to foreign exchange controls that have to be adhered to when a Chilean company pays up a dividend to a foreign parent. Brazil is probably the most popular destination within Latin America for many companies to do business. And they are very much a law unto themselves and different to other countries. So they don't have the concept of a branch effectively because you require presidential approval to set up a branch in Brazil. Your only real option in Brazil is setting up a limitada. There is no withholding tax on dividends, but there is a 15% withholding tax on interest and royalties, which rises to 25% if the interest and royalties are being paid up to a tax haven company. There is a significant bureaucracy involved in repatriation. For example, you need to register all foreign investments in the subsidiary with the Brazilian Central Bank through its a specified electronic system. The remittances of funds from Brazil need to be made using very set routes, codes, and foreign exchange paperwork. And for payment of royalties, the underlying intangible must be registered. So, ladies and gentlemen, I hope this has been useful in giving you a very quick overview, which is all I have intended in this case. Obviously, specific circumstances of a company will change the requirements as you go along. The common pitfalls, however, this is the key message I want to convey. The common pitfalls that you should avoid are the following, because we see these mistakes happening time and again, and usually they come from a lack of an adequate understanding of local rules. A good example being the dividend, there being no dividend withholding tax in India, but there actually being a dividend distribution tax on the Indian company. Secondly, failing to carry out advanced planning. So, for example, particularly in the case of China. Thirdly, not inquiring into issues other than taxes, foreign exchange controls being a very relevant example. Fourthly, not realizing the level of documentation and compliance requirements required. Fifthly, ignoring transfer pricing requirements and their impact on what can be paid. Not checking how the repatriated taxes will be dealt with in the destination country, and I think Jay is going to cover that. And last but not least, ignoring local economic conditions. So, for example, Cyprus is a great place to set up a Russian subsidiary, but for the fact that if you put money in the bank, you're probably going to lose it. So it's probably not that good a place after all. On that slightly humorous note, I want to thank you very much and hand over back to Colin.
Shan, thank you very much for that interesting overview. Really appreciate it. And again, I want to take this time now to launch our first of 3 polling questions. And everyone should be seeing this on their screens momentarily. I want to take this time to remind every one of you who are attending today's webinar for CPE credit, you must take all 3 polling questions to receive full credit. But we urge all participants to answer the polling question as it is statistical in nature, and if we do have enough time, we'll share some of the results with everyone and get some of the feedback from the speakers. And at this time, I also want to remind everyone to utilize the GoToWebinar questions box to ask any questions you may have that we can start discussing during our general Q&A session. And I'll give everyone about another 5 seconds with this, and we will move to our next portion of our webinar. So it gives me a great pleasure now to introduce our second speaker of 3 speakers during today's webinar. It's Jay Tata he's a tax partner at KPMG. Jay leads KPMG's International Corporate Services tax practice in New England. He joined KPMG in 1999 and was promoted to partner in 2007. Jay specializes in international corporate taxation and has a strong background in corporate and partnership taxation, M&A, and accounting for income taxes. His experience includes assisting multinational corporations with global tax planning, cross-border acquisition, financing structuring, post-transaction integration, and legal entity rationalization, as well as foreign tax credit planning and foreign cash repatriation planning. Jay has an extensive experience providing domestic and international tax structuring advice and tax due diligence, assistance in acquisition transactions. The floor is yours, Jay.
Great. Thank you, Carlo. Hello, everyone, and thank you very much for joining today, and I certainly appreciate the opportunity to speak with you. I think Shan did an excellent job of framing the issues around cash repatriation, and I'm going to spend a few moments talking about best practices in the area. Most importantly, when I think of best practices, is to do upfront planning and think ahead as far as where is my profit going to be generated in the future, and how will I get access to that cash later down the road. Proactive planning goes a long way in making the overall repatriation more tax efficient. certainly another thing that was mentioned is you need to consider a variety of things. And obviously one of the considerations in cash repatriation is the tax considerations. And that includes a variety of different taxes. So obviously you have the non-U.S. withholding taxes, and Sheehan mentioned quite a bit about the regimes in the different countries as far as what their withholding tax obligations could be. You have to think about the non-U.S. income taxes as far as moving cash up a chain of entities. So obviously you're not always dealing with cash repatriation from a first-tier subsidiary. Often you have to go through multiple chains, and you need to consider what friction or tax cost there will be to move that cash up the chain. From a U.S. tax perspective, again, and most of this discussion will be framed around a U.S.-based multinational that's looking to repatriate cash from non-U.S. subsidiaries, you have to think about what is the ultimate U.S. tax cost of getting that cash into the U.S. So just to frame the U.S. tax system, obviously, to the extent you have a U.S. corporation with a foreign subsidiary, the general rule is you do not pay U.S. tax on the earnings of the foreign subsidiary until that cash is distributed back, or until those earnings are distributed back to the U.S. There's obviously exception to that general rule under our Subpart F regime, which really deals with passive income. But again, that's the general rule. So now when you look to bring cash back, you're usually looking at a U.S. tax cost that's around the difference between the U.S. tax rates, which are obviously high relative to the rest of the world, and the taxes that have been paid in the local jurisdiction. And that incremental cost is typically, at least from a big picture, what you need to think about as that cash moves back to the U.S. You do get credits in the U.S. for the taxes that were paid in the local foreign subsidiary jurisdiction, but those credits, the way you calculate them and the potential limitations on those credits can sometimes be a bit unintuitive. So I think as far as a best practice, again, it's important just to think through how much credits would be available and what the limitations on those credits would be in advance so that you're not surprised by them when the cash actually gets distributed. Another thing to think about when you're just talking about cash repatriation and what is a best practice, typically you're looking to take advantage of the attributes that you have. The difference between a cash repatriation that's efficient versus one that's not efficient is really how well you take advantage of the attributes that you have within your organization. And those attributes can be things like net operating losses, foreign tax credits, losses in some jurisdictions that maybe can offset gains in other jurisdictions, some jurisdictions where earnings may have, for various reasons, been subject to a high tax rate versus a low one. So the ability to use those attributes effectively is really what drives down, or potentially and hopefully, the overall tax cost of getting that cash back to the U.S. As she had mentioned, it's not just tax implications that are relevant. So a few other things that I'm highlighting here is obviously there is legal restrictions in many jurisdictions as far as the ability to move cash. For example, most European countries only allow for cash distributions to the extent you have sufficient distributable reserves, which is really historic financial reporting profits, outside of a true capital reduction, which can sometimes take longer to effectuate. There's also the accounting and financial reporting implications of the repatriation. So not only do you have to think through the current tax costs and how those current tax costs may hit your financial statements, depending on certain assertions you have made with respect to your foreign earnings, beginning to repatriate those can give rise to needing to record additional deferred taxes for the unremitted earnings that are left behind. So again, an important consideration is to just think through not only the financial reporting consequences of the current cash taxes, but as well as any deferred taxes that may have to be recognized as a result of a cash distribution. At the bottom of the slide, I tried to list a few of the other tax attributes. One thing to keep in mind is to the extent there are existing loans between the U.S. and foreign subsidiaries or between foreign subsidiaries, it can be advantageous to take advantage of the existing capital structure within the group. So just something to think through. Moving on to the next slide, how can you make a transaction potentially more efficient? So obviously you're looking for your attributes, but what are some of the mechanisms or best practices to make a cash repatriation plan more efficient? Are really things like, is it better to do a share buyback versus a distribution? Is there a way to structure a transaction so that the treatment in one jurisdiction from a tax perspective, as far as the character, may be different than the character of that same distribution in another jurisdiction, and potentially play off of those differences in the tax rules? So I mentioned Section 304 transactions and reorganizations. Not going to get into it in this brief time, the specifics of those, but again, the type of transactions you'll see people utilize to access that cash. A few other ways that are outside of a true equity distribution or a dividend to access cash that should be considered are if you can use parent stock in the subsidiary, either for granting restricted stock to subsidiary employees or for exercises of options for foreign subsidiary employees. Having that subsidiary purchase those shares from the parent is a way of efficiently, moving cash. Also, you can look at things like if there are transactions between the foreign subsidiary and the U.S. parent, like royalties or inventory purchases. Sometimes prepayments of those royalties or inventory purchases allow for potential movement of cash without as much tax friction. So we talked a little bit about best practices. Again, I think the key themes on that are be proactive, plan ahead, understand your overall corporate structure and how you can take advantage of it. And probably accept the fact that there's going to be potentially some level of tax cost to move cash. Again, the goal isn't always to get to zero cash as much, to get to zero taxation as much as make it as efficient as possible given the overall structure and the needs for cash around the world within an organization. Moving on to corporate tax structure and the potential benefits of a holding company. And I think Shan mentioned some of this earlier. The primary benefits of a holding company outside of the U.S. or to hold subsidiaries outside of the U.S. is it does allow a mechanism for cash to move around between those subsidiaries without necessarily coming back to the U.S. and without necessarily being subject to U.S. taxation. Now, there's obviously some exceptions to that, but as a general rule, that holding company does give you a lot more flexibility to plan for distributions and to plan for cash needs around the world in a way that is more tax efficient. The other thing a holding company can do is, depending on the jurisdiction of the holding company, as well as the jurisdiction of the operating entity that has the earnings to be distributed, you can potentially lower the withholding tax pursuant to that treaty. So sometimes it is, you think through which jurisdiction would be a good jurisdiction from a treaty benefits perspective to minimize withholding taxes. And obviously in that consideration, you need to think about the substance requirements in a holding company to make sure you actually qualify for treaty benefits. A few other just odds and ends as we move through the benefits of a holding company. It does allow for a potential leverage distribution. So one thing we do see within our client base is holding companies that will borrow cash from a third party and distribute it before such holding company had its own earnings. Later on, when the subsidiaries of the holding company distribute their earnings to the holding company can repay the third party debt. But by staging it in those, from a timing perspective, step one is a leverage distribution, and in the future, a distribution of earnings, it does allow for potential efficiency from a U.S. tax perspective. The other thing a holding company does allow for is just planning ahead and thinking, where do I have income? Where do I have losses? How do I potentially, at a minimum, offset the two? Where do I have high taxed income? Where do I have low taxed income? How can I potentially net the two in an efficient way to get cash back to the U.S.? I will mention just in passing that there is an Obama proposal that's been out there for a few years in a row to really aimed at this ability right now to pinpoint which distributions or which cash pools you're coming out of and potentially trying to plan for the high taxed pools. And that proposal would really require a consolidated approach and require a company to blend the tax pool of all its subsidiaries in calculating the indirect foreign tax credits that are available. So this may be a window as far as the ability to isolate high taxed earnings that may not be out there forever. So something else to think about as you're thinking about your cash repatriation plans. The last point I'll make before I turn it back over to Carlo, just in the nature of time, is that to the extent you have built up a fair amount of cash offshore from the operations offshore, one use of that cash can be the foreign subsidiary or foreign holding company buying certain intellectual property rights from the U.S. Now, while that does have a tax cost, because that transfer is taxable from a U.S. perspective, it does allow cash to move and long-term IP rights to be held outside of the U.S. So if you're going to be subject to tax anyway on a dividend distribution, there may be some long-term benefits to doing that cash transfer as an IP purchase. There's obviously a lot of other requirements to make an IP migration effective from a tax perspective and workable, which we're not going to get into here, so I don't want to oversimplify it, but that is something to be considered. And with that, Carlo, that's what I had for best practices and the benefits of holding companies. So thank you all very much for your attention. I very much appreciate it.
Thank you, Jay, for those great insights. Real quickly, before I do go into our second polling question here, we did have a couple questions around the Obama proposal. Can you just briefly give us, I know you went into it at a little bit of high level, what does it mean from a action perspective, and then ultimately, what's the likelihood of that proposal being passed? Any insights on that would be great.
Sure. So there's certainly a few different proposals from the Obama administration and from others within the Senate that deal with long-term taxation in the U.S. The one I mentioned specifically was this requirement that foreign tax credits be done on a consolidated basis versus an entity-by-entity basis. There's also another one that provides or reduces some of the tax efficiency associated with what we call all-cash de-reorganizations, which is really a way of potentially transferring one foreign subsidiary to another for cash without immediate U.S. taxation. Those proposals have been out there for several years. Certainly there may be closing windows with respect to those planning items, so if those items are things that may be valuable to your organization, it would be prudent to explore them certainly in the next year or in the near term, because it is potential that those rules will change. At this point, very difficult to hedge the likelihood of any of that being enacted in the short term or even in the midterm. I would say, in my own personal opinion, and again, minds can differ on this, I think the likelihood of some of those proposals passing in the next 12 months is probably lower. You go 2 or 3 years out, I think it is more likely we will see some of those get passed.
That's great, Jay. No, I appreciate that, and I think we can definitely speak more about it as more questions come through in the general Q&A. So as Jay mentioned, we will launch our second of 3 polling questions. You all should be seeing this on your screens here momentarily. Again, I just want to take this time to remind all of you who are here for CPE credit today, you will need to answer all 3 of our polling questions. And at this time, I also want to remind you to utilize the question box in your GoToWebinar panel. We do have a few questions already coming in, and we will utilize as much time as we can in the Q&A session to get to as many of those as we can. It gives me a great pleasure now to introduce our third speaker of today's webinar, Venkat Eswaran. He is the Senior Vice President of Global Services for Nair & Co. Venkat heads the Global Services operations of Nair & Co. and oversees the delivery of all client services. Venkat joined the company in 2003 and worked in operations and client services before moving on to a management role. He has played a significant role in expanding Narenco's India's operations from modest beginnings. Venkat is an expert on India inward investment and acts for a variety of private equity and VC firms in addition to multinational companies of varying sizes. Venkat is a qualified Indian chartered accountant and a tax expert and has more than 22 years of experience in multi-country management accounting, audits, and has assisted transnational organizations in leading Indian enterprises across sectors on regulatory, tax, financial, and business advisory-related matters. Take it away, Venkat.
Thank you, Kalu. And thank you, Sean and Jay, and welcome to all of you. Thank you very much for being here now. Kalu, I just wanted to move the slide, if you could help me there. Yeah, thank you. So Sean briefly touched upon India, and he did mention about the dividend distribution tax in India. In the short time which I've got actually on India and China, I'll try to do some brief touch points. Obviously, if you drill down more into the detail, you would require a completely different webinar which Proformative has to organize. But since due to the time being short, I'll just go ahead and see. The general introduction to the rules on repatriation of profits. India, unlike what is generally felt, is it permits free repatriation of profits. The only condition they impose is that you got to pay all the applicable taxes. So as long as the taxes are paid, it permits free repatriation of profits to all the countries across. There are differences in repatriation of profits based on the type of entity, which Sean briefly touched upon when he said that companies have to pay a dividend distribution tax, though there is no withholding tax, and branches can remit after payment of taxes. Now there is a new entity called a LLP, which is a limited liability partnership, which is considered as a partnership, and the income from that is not liable for taxation. So obviously you could remit profits from an LLP outside India without any withholding tax at all. But before we all jump into forming LLPs in India, please be careful that LLP requires the approval of the government. So before you actually venture into constituting an LLP in India, you need to undergo a procedure of getting a government approval to form the LLP. Once you get the government approval, obviously, you could use that as a vehicle to get profits out of India without any taxes as the law stands today, right? And there have been different ways in which people have tried to get profits out of India without paying tax or paying minimum tax. One of the things which people used to do is, like, they used to look at, the companies used to actually look at the provisions of the Indian Income Tax Act, which said that 10% is the withholding tax on royalties paid to local Indian companies. When one Indian company pays another Indian company a royalty, it has to withhold 10%. So even if there was a double tax treaty between one country and India, which specified a different rate, the companies used to take the cover of the Indian local tax, which had a lower rate, and only withhold 10% and then get the money out. The government has become wiser to it, and the finance minister in the Union Budget 2013 has actually instituted a new procedure which says that the DTA rate is what is going to be taken, and he has increased the Indian tax rate of withholding from 10 to 25%. This adversely affects companies which were having DTA rates which were more than 10%, because if your DTA rate is more than 10%, then obviously you'll have to pay more than 10%. And there are a lot of documentation requirement if you want to get money out of India, though it's freely repatriable, and after payment of applicable taxes, there are very stringent documentation requirement. What I have done, we can come to that later, that's in that I've tried to work out two examples, one for India and one for China, which would give you guys an indication of the sort of documentation which you need to do to get money out of these countries. So you've got to time your repatriation properly when you come to repatriating funds, and ensure that you take you have sufficient time in hand to actually collate all those documentation. Now coming to China, the standard modes of repatriation in China is the same: dividend, interest, royalty, service, fee. And you got to be, China also has got a complex web of rules and regulations which generally need to be taken care of before you start remitting funds out of China. You got to, the foreign companies which have entities there have to apply for a foreign exchange registration number, and then with the foreign exchange registration number, then they got to obtain a foreign exchange registration certificate, open a foreign currency bank account, get the money transferred, converted from renminbi to convertible foreign currency, and then start the process of repatriation. You got to also be careful that interest, royalty and technical fees do carry business tax or VAT, and therefore the withholding rate for interest, royalties and technical services are more than you have on dividends, where dividend withholding rate would be about 5 to 10%. The interest withholding rate, including the business tax, could be 12 to 15. The royalties would be between 11 to 16, and the technical services could be between 20 to 31. So you got to be careful about the fact that there is a business tax and a VAT for other income apart from dividends. In case of dividends, there are very, very stringent documentation requirement, which obviously I'll come to a little later, which I've worked out in a complete slide, which would give you what the documentation requirement is. Apart from that, as earlier mentioned, there are thin capitalization rules. You've got to show substance to take treaty benefits. There should be beneficial ownership. You've got to ensure that the foreign investor demonstrate commercial substance to be considered a beneficial owner to take advantage of the tax treaty. So all that you've got to be very careful of. And the use of holding company, Hong Kong as a holding company, is a very, very popular and most used option. And the reason for that is definitely having a holding company in Hong Kong is to take advantage of the tax rates, the ease of documentation, lesser withholding, ease in opening and operating in Hong Kong vis-a-vis operating in China. You have lesser withholding tax on dividends if you are actually investing from Hong Kong to China, and Chinese subsidiary were to repatriate dividend income back to Hong Kong. It could be 5% of the beneficial ownership of the Hong Kong entity is more than 25% of the capital of the Chinese entity. Apart from that, as earlier mentioned, dividends received by a Hong Kong holding company from a China company are tax-free, since there is no dividend tax in Hong Kong, and hence the dividends can remain in Hong Kong, can be used for investment in the region or worldwide. Besides that, a lot of locations in China do not really demand or require a tax residency certificate. So that's an advantage of having Hong Kong as accounted to actually invest in China. The next slide actually gives the documentation requirement for India for remittance of dividend. It actually specifies what all you need to actually do. You've got to fill a form, you've got to have the certified copy of the audited balance sheet, you've got to have the resolution, you've got to have the Reserve Bank of India approvals, you've got to get a certificate from a chartered accountant, and apart from this, any other document which an authorized dealer or a bank would require needs to be presented. And once all this is actually given to the banker would then sanction you foreign exchange so that you can remit it out of the country. This shows the extensive documentation requirement which you have in China. In China, you have extensive documentation requirement. You have to, there are about 2 slides of requirements which you need to do to get the money out. As earlier mentioned, you got to get the remittance of dividend verified by a bank authorized by the State Administration of Foreign Exchange. The application letter and all the documents have to be submitted, all the requirements need to be fulfilled. Apart from that, you've got to produce tax returns, certificate from the tax authorities certifying that the payment has been made, credit reports, foreign currency registration certificate, which we touched upon earlier, and any other documents which would be required by the authorities, which is the State Administration of Foreign Exchange. And this processes can vary depending on the city or the bank where it is located. So that is one more thing which you need to bear it in mind, that there could be slight changes depending on the city and the bank which is actually remitting the funds. So with that, I would like to thank you, all of you, for having listened this presentation, and I'm open for any questions you would like to ask. Thank you very much.
Venkat, thank you so much for sharing those great insights on both India and China. And I'd like to open it up now for the general session Q&A. We have had a few come through throughout the event, and I urge anyone else who's out there who would like to get a question asked, feel free to utilize the question box in your GoToWebinar panel, and we will get to as many as we can during the next few minutes. So this is a question from the audience, and Shan and Jay and Venkat, this is open to all three of you, and be interested to see kind of your perspectives on this. Are there any specific countries that pose a significant risk of their governments changing the rules on repatriation of profits?
It's certainly a good.
I would say at this point, in all of the major countries, this is Shan here. Certainly in the countries that I've just covered in this webinar, probably not. But it does change a lot with the ebb and tide of the world economic conditions. For example, in Europe, Greece and Cyprus are not very favored or stable destinations. At one point, Ireland was thought to be revisiting its corporate tax rates and all of its other tax-efficient offerings, but decided not to do anything with that for the time being. So I think the answer right now is a cautious no in terms of the key countries, but equally a request to watch this space very carefully, literally quarter to quarter.
And I would agree. I guess the only two other things I would mention is we have seen some recent changes in the rules regarding share repurchases in India. We've also seen some changes with respect to China. And probably the other thing to mention is not all change is bad. The UK, as was mentioned at the beginning of the session, passed a lot of favorable rules from a holding company perspective over the last 6 to 9 months. So not all change is necessarily bad.
Yeah, Argentina also not that long ago imposed foreign exchange controls.
India has actually recently changed that buyback rule. Earlier, people used to use that as a vehicle to actually remit funds out of India instead of distributing it as dividends. Earlier, if you could distribute dividends, then you had to pay a dividend distribution tax, whereas if the shares were, purchased back by the company and the money was not liable for dividend distribution because that was considered as a capital gain, the government has seen through that, and they have introduced rules which actually now start taxing the buyback of shares as well. So that particular loophole which was there has now been removed.
Great, thank you for that, guys. And this one's more for Shan and or Venkat. So Shan, you went through kind of APAC or Asia a little bit. What's your kind of thoughts or consideration on Korea? Anything that you can share in the next couple seconds, and Venkat, anything that you could share as well?
On Korea, actually, Korea is pretty unique among the APAC countries in that if you're starting up an operation in Korea, Korea has the concept of Class B employment compared to Class A employment. Class B employees can typically be directly hired by a foreign company without setting up any type of entity in Korea whatsoever. And for that particular type of employment, and there are numerous criteria that relate to the proposed activities of these employees and their relevance of these activities to the core business of the client. Essentially, there is no permanent establishment risk by the foreign company directly hiring Class B employees in Korea. Class B employment is also pretty attractive to the Korean employees because they get a certain amount of their income shielded from income taxes. But the downside is that the employer, i.e. the foreign company, has got to pay a taxpayer association fee, which is a kind of annual fee. Class A employment is a conventional employment, which is typically when you set up a subsidiary. One of the more popular ones is the Choosing Hostel subsidiary. That type of subsidiary employees would be Class A employees, and it's easy to move from B to A, but it's difficult to move from A to B. So Korea, in that respect, is actually a very easy country to enter, but it's not that easy a country to exit from once you end up with a subsidiary there and with employees there. That would be my very brief 10 cents worth. On profit repatriation, again, depends where the parent company is, but between US and Korea, the amount of paperwork and regulations is much less than in the case of China to US or India to US, because the Korean won is not a non-convertible currency. So, a lot of the Forex regulations don't apply. The stringency, that level of stringency does not apply. But there are, nevertheless, foreign exchange type reporting requirements, but they're not as stringent.
Great. Thank you for that, Shen. And just unfortunately, looking at the time, we are meeting our max here, and we have about a dozen other questions. So I would, greatly appreciate it if you, Shan, Jay, and Venkat wouldn't mind answering these questions directly after the webinar. So we will get to everyone's questions, just not right now, folks. Just with some last housekeeping items before we do close up this webinar for today. At the end of the webinar, you will be prompted to take a short survey, which we truly value your feedback and appreciate your time in helping us continue to deliver the great content. At that time, you will also have the opportunity to request an introduction to either of our speakers as well as Nair & Co. With the click of your mouse. And please join us in continuing this discussion on Proformative.com. And for any questions around CPE, please contact Chris Brower at Proformative. Proformative.com. I'd like to take this time, too, as well, to thank Nair & Co. For sponsoring our event today. Without their great sponsorship, we will not be able to bring you this great content and speaker lineup as we do for everything here in Proformative for free. And we really appreciate your time, Shan, Jay, and Venkat, for sharing your great insights. And with that, I will go ahead and launch our third and final polling question. And everyone should be seeing this pop up on your screen here momentarily. And I will give everyone a few seconds to answer this. But before we end today's webinar, I'd like to thank the audience for their time and their great questions. Unfortunately, we did not get a chance to get to all of them. But as mentioned, we will get to you directly after the webinar. And we look forward to seeing you again here at Proformative, another Proformative event, or online at Proformative.com. Have a great rest of the day, folks. And I will close out this polling question here and a short survey to follow. Thanks again, and enjoy the rest of your day.